Hello, everyone, and welcome to our monthly webinar. My name is Justin Cooper. I'm a hard money lender and full-time real estate investor and coach and consultant to investors. Each month, we bring in some of our friends in the industry to share their expertise. This may be through a presentation, like when we talk about self-directed IRAs or title insurance, or we may simply interview our expert friends and dive deep into how they got started, where their investing has taken them, and what they see coming both for themselves and for the industry. Now, I want to say thank you to everyone who made it to tonight's event. We know that you're giving up some of your time, so Peter and I will do everything we can to bring you the value you're hoping for. Now, this webinar is brought to you by Pine Financial Group. Pine Financial is Colorado and Minnesota's premier hard money lender. Pine focuses on the needs of Colorado and Minnesota real estate investors, and we're investors ourselves, so we know what it takes to get deals closed. Everyone at Pine Financial Group is dedicated to the success of its clients. We only experience success when our clients are succeeding. So we have a habit of telling you when a deal should or should not be done. And isn't that what you want from a professional in the industry, especially someone that you trust as an advisor? You will benefit from our honesty and integrity when you choose to work with us. Now, I want to talk real quick about two upcoming events that we have. I want to make sure you guys get these on your calendars because they're coming up very quick. We've got our Investor Success Summit just around the corner. In Minnesota, the event will be a Saturday, September 28th, so just a couple weeks away. And in Denver, the event will be Saturday, October 12th. So if you are around, you got to make sure you hit this event. This is by far the best real estate investor events in both states, bringing in hundreds of other investors and attendees, no sales pitches, really is just packed full of local relevant content. So if you're in Minnesota, you can register for the events and attend at www.mniss.com. MN as in Minnesota, ISS like Investor Success Summit, mniss.com. And the Denver event is at www.denveriss.com. Now, tonight's webinar may not be the sexiest topic when it comes to real estate investing, but it is certainly vital to growing and thriving businesses. We're talking about a lot of the back office items like tax planning, bookkeeping, entity structuring, financial analysis, and team building. And who better to talk about that stuff than Peter McFarland of Business Innovation Group. Peter was driven to practice in the field of tax law because he wanted to stand at the intersection of life's most important events and help clients navigate through them. Peter earned both his Juris Doctorate and Master of Laws in Taxation from the University of Denver. He has successfully counseled clients through tax litigation, estate planning, business entity formation, and asset protection. He also regularly speaks to business associations, investors, and other attorneys on the complexities of tax law. Peter, can you go ahead and tell us a little bit about yourself before we dive into tonight's topic?
Absolutely. Thank you very much, Justin, and thanks for the nice intro there. I mean, where to start? But I guess before I talk about really any of my companies or my groups, I actually just want to throw it back really quick and pay Pine a really nice a compliment, and you a really nice compliment, Justin. I've had the pleasure of working with you guys for a really long time. Gosh, it's probably 6 years now. Does that sound right?
Probably is, yeah.
Yeah, and just in the time that I've gotten to know you personally and kind of work with Pine generally, I really can't recommend you guys enough to any of my clients, and to see the way that you guys have treated my clients over the years. There's no doubt that you guys are the go-to lender for really the vast majority of my clients, particularly for certain types of deals and deals that may be a little non-traditional or may need to be a little creative. And it's just really great. It's been a really great partnership, friendship, all of that. And I really can't say enough good things about you guys. But with that said, now I get to talk myself up, right?
There you go.
Yeah. And I don't like to do a lot of sales pitches, and I'm going to try to stay away as best as I can from kind of the sales pitches tonight. I'm sure everybody really would appreciate that. But my name's Peter McFarland. Justin already has given a really great overview of who I am. I am an attorney, been licensed since 2011 now, which is blowing my mind because in my head I still feel so kind of fresh and out of school, but really I'm coming up on a decade of being licensed, which is nuts. But at any rate, I've been published in several different journals about real estate issues, things that you need to keep in mind, crossing the border between tax and real estate itself. And really, the law side, the law practice has been a ton of fun, very rewarding. But that said, we saw real opportunities with our clients to do more, and that's where Business Innovation Group comes in. And so Business Innovation Group is actually a partner company, a sister company to Long Law Group, our law firm. And really what it does is it provides business advisory services. And business advisory is a little nebulous. And here what I want to show you is that it's not just me, it's actually my whole team, right? Because no person is really a master of everything, right? And you have to rely on your team. And so, traditionally, if I gave a webinar, I'd kind of talk about this slide and just be a picture of me and kind of, a celebration of me and only me, right? But that's not what this is about. This is about leveraging the expertise of really everybody on my team. And everybody that you're seeing here on this slide is a professional in some capacity. We have CPAs, we have bookkeepers, paralegals, accountants, 2 attorneys. And doing all of that, we do this business advisory, and business advisory is kind of this nebulous topic, but really what we try to do is just improve your bottom line and improve your business in any way, shape, or form that we can. And if we can't do it, then we try to partner you with somebody who actually can. And so Justin mentioned that it may not be the sexiest topic tonight about real estate investing, and in a lot of ways he's right, but kind of what my intro and kind of what Justin was saying in that bio is very true. Even though nobody wants to talk about or think about tax is really, and your finances and your bookkeeping and everything, all of your numbers, right? Really just all of your numbers. That is what connects everything. It's at the center of everything. And so I think in that bio, it went something like, I stand at the crossroads of life's biggest changes and events and all of that. And it's true. Always your numbers are running with you, and always they're part of these crossroads, right? So business advisory and business innovation group really is about looking at revenue and profit improvement, cash flow analysis and forecasting. We're going to do tax planning and preparation. We're going to do bookkeeping. And then behind all of that, just in terms of legal compliance, we're going to look at business entities. We're going to look at executive development, team building, price optimization, and we're going to look at real estate strategy and planning and try to pull as much of that together as we possibly can. So with that, I'm going to talk a little bit about an opening perspective here. If you think about the life cycle of a business, right, you're going to have your startup phase and you're going to grow. At some point, most businesses hit a plateau, and that's really where they stay. Looking at the law firm over the past few years, and this is somewhat of the genesis of the Business Innovation Group, or why we decided to create this other company, is that we hit a plateau in the law firm. Everybody was basically tapped out. And if you think about a lawyer, by and large, what we do is we work on an hourly rate, right? And there's only so much hours we can put into the day. There's only so much work we can do. And so we needed to grow, right? And so in the life cycle of a business, what you'll see is that you may start up, you may plateau, and if you never break out of that plateau, you're going to stay at that plateau until you exit or you dissolve, right? What we're trying to do with Business Innovation Group and in partnership with Law Group is actually address growth, right? We want to be in that left-hand side of those images there. And if you hit that plateau, we don't necessarily want to go down like that image does, but we want to push forward to the goal. We want to get growth to happen rather than just to stagnate and eventually dissolve, right? And so really I'm focusing almost exclusively on growth. And you can see that's actually the image got a little messed up there, but that's actually what our logo there is supposed to represent. So tonight I'm going to talk about 6 pillars to getting bigger success in your business, in your investing, in your venture, right? And you can see by these arrows, a lot of them, what they do is they feed into each other. And so you may look at it and you may say, Peter, I've already done my entity structuring, I'm done, right? Well, yeah and no, right? That's going to lead to these plateaus. You know, a lot of people don't want to pay for bookkeeping. They keep their stuff in Excel. They say that that's fine. You know, it may be. You know, you might be in compliance come IRS audit time or tax preparation time. But without that, without good bookkeeping, you can't move on to financial analysis. You can't do effective tax planning, right? And if we can pair a good bookkeeping with financial analysis and effective tax planning, that's going to take your business to the next level. There's also elements of price optimization and team building, and we'll talk more about those. But tonight, I'm really going to break down these 6 pillars, right? If you do all 6 of these, you'll find that your business is going to move to the next level.
And so as Peter's going through, if you guys have any questions for him, feel free to just jump into that question section, throw out any questions you might have. I'll be checking that and obviously interrupting Peter as he goes with any and all questions. So feel free, if you do have a question, don't feel like you have to wait till the end. Just reach on out at any time.
Yeah, absolutely. Justin, do you have any questions?
I do. No, not yet.
Good, good. All right, so if you've been on a webinar with me before, you've seen me before, and I know that there's a lot of crossover between our client base and Pine's client base and things, but you know that I am big into entity structuring and compliance. I will admit this is absolutely not the first time I've presented these slides. So for a lot of people, the structuring part might be a lot of review. If you're just getting started, or maybe you know you haven't attended a webinar with me before, you may learn something new. But I've thrown in a section here about compliance, and I don't talk a lot about compliance, at least in webinars or speaking engagements past, because mainly I just want to make sure that people are actually getting structured correctly, right? So there is an element of new material here, so you know, don't have your eyes glaze over, you know, for the entirety of this. And I promise I am going to talk more tonight, talk about more than just business entities tonight. But at any rate, if I talk about an LLC can actually be taxed any numbers of ways. The tax code was written in 1986, and when it was written, there were no LLCs. So in the tax code, you have 4 different types of taxation. You have disregarded entity, you have a partnership, you have an S corporation, and you have a C corporation. So if that was written in 1986, LLCs being a product of 1991, means that when you set up an LLC, the LLC can be taxed any number of these ways. It can be an LLC taxed as a disregarded entity, an LLC taxed as a partnership, an LLC taxed as an S Corp, or an LLC taxed as a C Corp. It's a really fun, at least I think it's really fun, and this is the nerdy lawyer in me coming out, but it's a fun thought experiment to just drive down the road and look at the signs and see how many LLCs there are compared to corporations or partnerships, right? LPs for partnerships, GPs for partnerships, or INC, or even LTD for corporations. Just notice what people are using. By and large, 98% of the time, if they're not, say, a doctor or a lawyer, somebody using like a professional corporation, you're going to see that they're using an LLC. And the reason is because they are this flexible when it comes to taxation. Really, you can have your cake and eat it too. This is one of the very few areas where you can, where an LLC is going to be protected and really strong for asset protection, but you have a ton of flexibility on the taxation side. For rentals, this is what I'm going to recommend. I recommend that you set up a multi-member LLC to act as a master LLC. That company is going to file a partnership return, a Form 1065, and then you're going to have single member LLCs underneath that. The single member LLC is owned 100% by that master LLC. And the advantage of doing that is that each of these sub LLCs can hold a property in the LLC. You get your eggs in different baskets. There's a little bit of just division within your structure. But overall, that entire structure, even though it's 4 companies, is only going to file 1 tax return. So it's nice and lean when you go to the CPA or the tax preparer, and you know, you're not paying them to prepare 4 returns. You're only paying them to prepare 1. But you've cornered off your potential liability because the properties are in each of these sub LLCs. So that's the recommendation for rentals. If you throw in anything else, and by anything else, really, I mean any other type of activity, if it's going to be fix and flips, if it's going to be brokerage income, like you're a real estate agent, if it's going to be wholesaling, tax lien buying, anything like that, I really would strongly recommend breaking it off into its own structure. So we're still going to create that rental structure if you're going to do rentals. But then over on this other side, we're going to create an S corporation or an LLC taxed as an S corporation. And the whole point of that is to save money on self-employment tax. So this is from afar, if you're going to kind of do everything in real estate, this would be a really viable structure and something that I would recommend for using LLCs. Justin, do we have any questions so far?
Well, Jay had a question saying that he's interested in tax planning and they're about to create an entity. So basically, I think exactly what you're covering right now.
Great, great. Yeah, well, Jay, if you have any particular questions or anything about, what that might look like or, what I might recommend beyond kind of what we're covering here, make sure to drop that in the question box. I'm more than happy to answer it. But I think from afar, it's a pretty straightforward structure. A lot of people do ask about like integrating trusts and how you might do that.
Hey,
The problem with
Peter, before you start chatting
no,
about trusts here, so if somebody was to start wholesaling, they should just form an S corp. That would be the way to go if they're just planning on wholesaling at the moment.
yeah, well, I mean, I guess
Or would
from
they
afar,
form a multi-member LLC and tax it as an S corp?
Justin, are you creating this question
No,
to test me, or is this a real question?
no, this is a real question.
Yeah, good, good. No, it's a very good question. It brings up an important point. The important, and that's why I was thinking maybe Justin was making this up. The important point here is that really every situation is different, right? And when I say that, that's not just me kind of being a lawyer doing the CYA thing. What it is when you use an S corporation, you're going to pay yourself two ways. You're going to pay yourself a reasonable salary and you're going to pay yourself a distribution. When you pay yourself the salary, there's headache, time, and energy that goes into that. You're going to work with a payroll company. You're going to cut yourself a paycheck at least once a year. So there's cost associated with that. There's also quarterly filings with the IRS, the Form 941s, and annual filing, the Form 940. And so to really subject you to that headache and make you jump through those hoops without a certain level of income would not be a smart move for me as the advisor, right? I'm not going to recommend you do that unless you really have a certain level of income. That also, I get the other question I get, and it's a natural question, is, well, what's the level of income where I would want to set up an S corporation, right? And that is difficult to answer as well because it's a sliding scale. I have a lot of clients who are, like they don't want to pay a single dime more to the IRS than they have to. And if that's the case, I might look around 30 grand, somewhere on the lower side like that. And that's net income, not gross income. So after your expenses, right? But I've talked to a lot of CPAs and I've partnered with a lot of CPAs, and a lot of CPAs may say something more like 100 grand net income. It just kind of depends on what is your tolerance for the headache and what's the payoff on the tax side, right? And that's going to be a sliding scale for a lot of different people, depending on just your willingness to go through it.
So got a couple other questions.
Excellent.
I think you started answering some of them. So one of them, I guess, as you're talking about tax advantages, if there's any others that you might have or say regarding both of these examples, what would those be? Tax advantages of both of these examples.
Like tax advantages of both of these structures, is that?
Yeah.
I guess, okay.
Yeah, correct.
Yeah. So on the right hand side, let's start there. So the master LLC and the sub LLCs, so partnering all of that together, there's not really any tax advantage that's going to go along with that over and above holding the rentals in your personal name. There are inherent advantages instead. So the thing is that both of these companies, the partnership LLC, which would be that master LLC on the right-hand side, I said that I wanted that to file a partnership return. That is a flow-through business entity. The S corporation on the left-hand side also is a flow-through business entity. When I say that it's a flow-through business entity, what I mean is that the company itself never cuts a check to the IRS. What it does is it pushes all of the tax impacts out to your personal tax return. And so because everything is pushed out to your personal tax return, these are really, particularly on the right-hand side, it's just tax neutral. If the LLC earns money, you're going to have to pay tax on that money, right? If the partnership LLC or one of the sub LLCs on the right-hand side incurs an expense and that's a deduction, well, you're going to get the deduction either way. So the only thing that this might do, and this being the structure on the right-hand side, the only thing that structure on the right-hand side may do is generate a few more deductions for you. For instance, you might have an annual meeting, right? And so maybe you go out to a nice dinner, discuss the finances and maybe what the picture looks like over the next year. You'll have to pay the Secretary of State some filing fees, things like that. I mean, these are very real expenses out of your pocket, but on the other hand, they're deductions that you may not otherwise have had. But otherwise, it's going to be truly tax neutral because it's pushing everything out. On the left-hand side, there's the S corporation, and there is a lot of tax planning that goes along with that S corporation. And it goes back to the idea that you're going to pay yourself a reasonable salary as well as a distribution. And I'm going to look at my slides really quick here from afar to see if I have a better slide to help us kind of envision this. And I do as a matter of fact. So, okay, so this is a way to look at an S corporation and why you would do this. So basically, when you have income flowing through the S corporation, I'm actually going to draw a little bit on this slide too. Look at me embracing so much technology, right? So can everybody see that drawing? Justin, can you see it?
Yep, we can see it.
Perfect. It's black on blue, which is not great, but whatever. So basically, if I have this LLC, and what I'm drawing here is 1120S because that's telling me that it's filing an S corporation, that it's a filing as an S corporation. If you have income coming into that LLC, when you pay yourself as the owner of that LLC, you're going to pay yourself two ways. You're going to pay yourself a reasonable salary and you're going to pay yourself a shareholder distribution. The reason that this is important is because there's self-employment tax due on the reasonable salary and there's no self-employment tax due on the shareholder distribution. So the more of your income that you can shovel down into that shareholder distribution category, the more money you're going to save, right? The less tax you're going to pay. The flip side of this is that the IRS is fully aware that this is a potential for abuse because, and if you read the tax court cases, it's always doctors and lawyers because they're the ones always pushing the envelope and always getting smacked down. But basically, if you're very successful and you pay yourself a $200,000 shareholder distribution and pay yourself a $0 reasonable salary, the IRS is going to audit you and you're going to lose, right? And you're going to wind up paying a lot in failure to pay penalties and accuracy related penalties and all kinds of nasty stuff. So they regularly audit this. They make sure that you pay a reasonable salary, and I've given entire presentations on what is a reasonable salary. So if you're asking that question, that's unfortunately maybe a little far afield for what we're doing tonight. But anyways, this is why this is important. So to go back to that slide that we originally were talking about, that's not it. To go back to this slide that we were originally talking about, and I see I still have my little drawing on there. At any rate, it's tax neutral on the right-hand side because everything flows through to your personal tax return, and rent being passive income and kind of that investment income, we're not really triggering any special tax implications. Over on the left-hand side, because anything else, wholesaling, brokerage income, fix and flips, whatever it may be, is going to generate self-employment tax, we need to create that S corporation to plan around the self-employment tax.
So Peter, you just used an interesting word, it would trigger something. And so there was a question on putting properties into an LLC, and would that trigger the due on sale clause?
Yeah, great question. And this is one of the areas where I don't really have a great answer. I actually did a different webinar a little bit ago with Joe Massey from Castle and Cook Mortgage, right?
Hmm. Yep.
Where we actually kind of went back and forth and talked about, what a lender thinks about this, and what needs to happen. And really, it was funny because going into that webinar, I was, oh, I don't know, I was a little, like, not nervous. Nervous would be the wrong word. I was just maybe a little concerned that, like, he and I were going to butt heads a little bit, but it actually turned out that we were in complete agreement through the whole thing. So what I'm going to tell you is a very conservative, flat, even answer. It's not going to be aggressive really at all, right? But if you were to take out a loan on a rental, and the lender for any reason requires you to put it in your personal name, or you shop your rates and your terms and everything else, and it just makes sense to have it in your personal name, and you close in your personal name, and then you put it into an LLC for the protection. Yeah, that's going to trigger the due on sale, due on transfer clause. I guess when I say trigger, that's maybe not exactly right. You're going to be in violation of the due on sale, due on transfer clause, right? And so that doesn't, it's not self-executing. It's not like all of a sudden, the clerk and recorder records that deed and alarms go off, and, all of a sudden your loan is called due. The lender has to look at it and decide to call it due, right? The lender has to, number one, discover it, but then number two, kind of go through their analysis and say, yeah, that's a big enough violation of this note that it makes sense for us to call this, right? Now, Justin, you guys are lenders too. Do you have any perspective on that?
I mean, it probably all comes back to the bigger picture of it all, right? I mean, there's going to be a lot of, headache and hassle potentially in calling the note due, and then, what's really the benefit of it? Now, we're obviously a very short-term lender, so, depending on what happened, we may or may not, trigger that. Certainly, well, I'm not going to say certainly anything, but people transferring it between an LLC and a personal name, that doesn't scare us necessarily. But yeah, I've heard of it a few times happening, on the longer term loans. Just had somebody actually call up to refinance the property into our loan, because they did something different. It wasn't transferring entities. They changed their strategy, and this was a larger commercial deal. And so they called us, and they pivoted strategies, advised the bank, the lender, saying, hey, just an FYI, I'm changing this. And they said, okay, that's great, but we're calling the note due. And so they had to come to us to refinance out of that loan they had. So sometimes that happens, and just ultimately just be prepared. There's always a chance that it'll happen. I mean, you're signing a document saying that you're aware of it, so just be prepared. And whatever that means, could it mean that you have to refinance? Does it mean you have to sell it? There's different options, and just be aware of that it could happen, and just think through a little bit of what would you do if it was to happen to you.
Yeah. And that's one thing I really like about you guys at Pine, is it just seems like being closer to real estate investing as a specific kind of activity, right? It's like I think you guys have a better grasp than a lot of lenders on what is happening and why people do what they do, and look at the bigger picture, kind of like you said. And so I, again, tremendous respect for you guys. But I guess to add a little something to the discussion here, I have seen, what did I say? I've been licensed since 2011. In that time, I have seen one note get called on one of my clients. And he said he was paying. I have to take him at his word for that. I don't know for sure, but it's rare. It's really rare when it happens. But the perspective there, I think maybe the mature reading of that is that interest rates are really low right now, right? If interest rates were to rise enough, so if we're at, for the sake of argument, I don't know exactly where we're at, but let's say 3-4%, we're in there somewhere. If all of a sudden interest rates rise to 8 to 10%, something like that, it might make sense for banks to call more of these due, right? And what they would really need is like a department or an automated script or something that would just cruise the county records in every single county and the clerk and recorders there, and just look for new things recorded on the title, right? And if they see it, and they can force you to refinance 5% 5% higher than where you are now, that might be worth it to them to implement that, right?
Yeah,
I don't know.
exactly.
Yeah.
So one more question here, and then I think we should probably dive back into you've got 6 things to go through, and we're maybe not even finished with the first. So one last question here. So when transferring these properties in and out of various LLCs, what kind of deed should you be using? Like a quitclaim, a journal warranty? Specifically, this question comes from because they heard that quitclaim can cause title insurance to be voided.
Yeah. This is really great. And Justin, you've been with me long enough to know that I love to hear myself talk. And so the fact that I'm hardly through one of my 6 points should not be a surprise. But the good news is that actually a lot of these go quickly. This is probably one of the meatier topics. But at any rate, to answer the question, I use a warranty deed. I always use a warranty deed, and the reason is because of that title insurance issue. Basically, from a high level, the difference is that a quitclaim deed only says it's basically saying I'll give you whatever my interest is in this building, and I have no idea, and I make no representations about what that interest is, right? So my office is at 55 Madison Street down here in Cherry Creek. We're right next to the Cherry Creek Mall. Pretty nice piece of real estate, whatever. But I could give you a quitclaim deed for my interest in this building. Now it just turns out that my interest is nothing, right? So it's a meaningless deed, but I could do it perfectly fine because I'm just saying whatever interest I have in this building is yours. So now you have a no interest in that building. The warranty deed, on the other hand, you're actually making warranties. You're actually saying at the time that I'm signing this, I have good title. There's no other issues with it that I'm aware of. I'll come back, I'll defend it if I need to and explain how I got it and why my title was good. You basically make all of these representations, and it puts subsequent buyers at ease because they know that they're buying actual title to the land, and that actually they have some assurances from you about the title from that land. So using that warranty deed keeps those warranties in place, and that means that it's insurable, right? If you use a quitclaim, on the other hand, it severs that because those representations are no longer there or valid, if that makes sense.
Yeah, very interesting. Thank you. And
Yeah.
then before we move on from the entity structuring, you had teased us with trusts before I interrupted you. So can you dive back into talking a little bit about trusts?
Justin, that was time filler. Now I got to move. No, I'm just joking. Basically, a lot of people want to use trusts. They want to integrate trusts. For me, trusts are purely an estate planning vehicle. They really are not an asset protection vehicle. You can use trusts for legitimate estate planning purposes. If you need to hold title in some investments, and you want to make sure that your kids are going to make good investment decisions, and so they're actually old enough to make those investment decisions. Say you want to lock it up until they're 35 or 40 or whatever, then that's where I think a trust would be integrated into this. It might own the master LLC or own a large portion of that master LLC on the right hand side. But there's 2 different kinds of trusts, and there's actually a lot of different kinds of trusts, but the two most common are irrevocable and revocable trusts. If you create a revocable trust, it is exactly as it sounds. It's revocable. And so if somebody sues you, and your argument when you go to the judge is, well, this is in trust, it can't be reached. And then the judge looks at it and says, but this is a revocable trust. What are we doing here? Just revoke this trust and let's be on our way, right? Revoke the trust, pay your creditor, let's be on our way, right? Kind of as easy as that to pierce through that trust. On the other hand, if you make it an irrevocable trust, that's a little bit harder for creditors to reach, and it kind of depends on how you split up the interests and who's the beneficiary and those kind of things. But leaving that out of the discussion, because really it's a whole can of worms. If it's an irrevocable trust, it's exactly as it sounds, irrevocable. So once you put that property into the trust, there is no getting it back out, right? And so to give up that level of control and enjoyment over your hard-earned asset just doesn't really make sense when we can equally protect it using an LLC, and you maintain all the ownership, control, and benefit of the asset. So hopefully that at least kind of broaches that topic. It's a larger topic, but there could be legitimate estate planning purposes we could look at.
Gotcha. Fair enough.
Cool. So let's move on. Have a lot of slides to get through for sure. So entity structuring, let's talk about compliance. This is kind of the section that I was teasing and saying, I promise I'm going to talk about more than just structuring. So basically with compliance, you have to look at your filings, right? You have your tax returns. So make sure, depending on how that LLC is taxed or how you've set up your company, that you file all of your returns. You can see, the most common there are partnership C Corp or S Corp. So the 1065, the 1120, or the 1120S. But remember, I was talking about payroll, right? If you become that S corporation and you're going to start paying yourself payroll, the W-2 reasonable salary, then you're going to have employment tax returns as well, the 940 and the 941, and then state and local filings as well. Aside from the IRS and the Department of Revenue and kind of your tax obligations, you also have your periodic report. That's a picture there of the old Secretary of State, Wayne Williams. We since have had a new one, so I've kind of aged the content of that slide. But at any rate, you have to file your periodic report, $10 with the Secretary of State, not a big deal. Hopefully shouldn't break the bank. But at any rate, that's probably one of the biggest pitfalls that I see people fall in, is that they just weren't aware that they had to file every year, or for whatever reason they just didn't. And so they think that they have an LLC and they're going to be protected, but lo and behold, it's actually delinquent, right? So you need to make sure you file that. Meetings and minutes, a lot of people don't bother with meetings. I think that that's a real pitfall. I go to events, for instance, some of these investor success summits or things like that, and I talk to people there about, creating an LLC, and they say, oh, I've already got an LLC, and I say, great, so you have your meetings and your operating agreement and your EIN and separate business bank account, and they kind of look at me and they say, no, I paid $50 to the Secretary of State. Well, you can imagine it's kind of a sliding scale, right? If you're sued and you're hauled into the courtroom, and the judge says, okay, well, why should you be protected? And you say, well, I paid $50 to the Secretary of State. That's not going to go very far, right? You have to have more formality to your LLC, more formality to your company. And so a way to do that is meetings and minutes, right? It's a great idea to have at least one annual meeting where you talk about, kind of how did the year go? How are you going to pare down expenses? What are you paying your contractors? Can you pare that down another 10%? Whatever it may be. And if you're a single member LLC, I still recommend you do this. I know that seems very silly and very formulaic, but really what you're doing is you're creating this narrative that says that this company is a separate and distinct legal entity from you, and kind of creating these minutes is a way to do that. For big items, for instance, I had to switch my bank. Wells Fargo, of course, being, and I hope I don't offend anybody if you work for Wells Fargo or whatever, but Wells Fargo, for lack of a better term, just really royally screwed me over on my company bank accounts. And so, I decided it was time for a change. So I moved all my bank accounts out to Navy Federal, and since I've moved on from them, but in an unrelated story. But at any rate, for these big items where you're like changing where you're banking, or if you're going to bring on a new member of the LLC, or maybe you're going to sell a property or something like that, for those big items, it's a good idea to call a special meeting, right, outside of those annual meetings, and just say, here's what we're doing. It's memorialized in the company records, right? So what do minutes actually look like? I really like to have them formal. If you've ever run into Robert's Rules of Order, I personally really like to do it there, or that way, kind of where you have a motion, it's seconded, it's voted on, unanimously passed, etc. I think that level of formality really speaks to judges. I think that they like that level of formality, but at any rate, that's typically how I approach it. Overall, what you're really just doing is you're just running the business in a business-like manner.
And so along those lines, Peter, specifically back to the master LLC and the sub LLCs, do each of the sub LLCs need to be holding these meetings? And so are you just like going through a lot of this formality if you're to set it up that way?
Well, yes and no. I guess Oh, Justin, you've worked with me long enough to know that like I can never give one answer. I always have to give two answers.
Right.
Yeah, and so it's kind of like the I's dotted and T's crossed, and the answer that's going to give you the most asset protection is probably to have a meeting for every single company, right? And if you have one rental in each property or in each company, you'd talk about what's happening with that rental in that meeting. And then at the top level, the master LLC, you might talk about just kind of the structure generally, and then like maybe overarching finances and maybe the tax return, right? But I recognize that that's a lot of work, and I don't like to create more work where I really don't need to. And there are a lot of other companies out there that will sell you on a much bigger LLC structure than you really need, kind of to run up their legal fees or their fees generally if they're not lawyers. But at any rate, what I would recommend is maybe doing a combined meeting, right? Because the ownership is the same, maybe call a meeting of the members of your master company, and then in your section of who is present at that meeting, list out kind of your name and then your titles. And so you would be a member of the master company, but you might also, the sub LLC would be present by and through you as the member of the master company, which is the member. And so you kind of have to piece together your titles and kind of style them in a way that makes sense, that shows kind of in what capacity you're there. But you could do a combined meeting where you're just kind of talking about everything, and then append those meeting minutes, that combined meeting minutes, to each of the company binders or all the company records, and also maybe throw in a resolution explaining why it's a combined meeting. Just say, for the sake of convenience and the fact that all of the ownership is the same in and amongst these companies, we're meeting as one, right?
Right. And so is this the meetings and minutes, these types of things, is this just for the LLC? Is this for the S Corp, or do these apply to both?
That's a really good question. One that it's a distinction that I actually rarely talk about. The advantage of an LLC, and another reason why there's so many LLCs compared to corporations, is that LLCs are less formal and there's less formality associated with them. So in an LLC, you could just have members and that's it. So you'd have a meeting of the members, right? In a corporation, it's kind of odd because what you have is you have officers like the president, the vice president, or the CEO, the CFO, right? You have the officers. The officers work for and are answerable to the board of directors. So then you have another body that's the directors, and then the chairman of the board is the chairman of the board of the directors, right? So they oversee the officers. Then you have the board, and then the board works for the shareholders, right? So in a corporation that's owned by you and your spouse, you actually have to have 3 meetings, right? You're going to have a meeting of the officers, which then reports to the meeting of the board of directors, and then the board of directors are going to present to the shareholders, and the shareholders are going to vote, right? So corporations absolutely kind of add a layer of complexity. So, and to be clear, if you're an LLC taxed as an S corporation, you don't have to go through all that rigmarole because you are an LLC. You could just have the meeting of the members. That's fine. But if you're a corporation taxed as an S corporation, you have to go through these extra steps because of how the corporate kind of structure or governance works.
Gotcha.
Does everybody think this is like, I don't know,
Oh, don't
like
ask for any
silly?
input. We're
Or
so far behind schedule, Peter. I mean, this is
yeah,
all like great content, and I think it's really important to be covering all this, but
yeah,
we've got 15 minutes left, and so I
we're
want to be
going.
respectful of everybody's time.
Yeah, we're going. We're going.
Peter, if you have some time to stay on a little bit longer, if necessary, then that would be great. But I want to be respectful of everybody's time as well.
No,
So
absolutely. Yep. We'll go. We'll keep moving, and I will stay on. But absolutely, I'll get through as much as I can. So good bookkeeping, right? Your numbers are the way that your business speaks to you. And inside your numbers, you're going to find golden opportunities, right? If your numbers are a mess, you're just going to miss those opportunities. So my question to you is, what opportunities are you missing, right? and the fact that good bookkeeping can actually point out those opportunities. And then from just a very real world standpoint, on a Saturday morning, do you want to sit down and look at that structure or that pile of books, or do you want to go out and have some fun, right? Bookkeeping is not fun. I know, I've done it. It's far below my hourly rate, but all the same, sometimes it just has to be done, even in an audit or something like that. It's not fun, right? And so going back to this idea, what golden opportunities are you missing, right? And the reason that I have this slide structured the way that I do is that good bookkeeping is going to lead its way into financial analysis and effective tax planning. And being able to have the language of your business clear and speaking to you is going to open up doors in financial analysis and effective tax planning, which is really what big and what we're trying to do. So I highly recommend, if you have not looked at a bookkeeper, looking at a bookkeeper, because really for the extra cost versus the time you're going to save, either having fun or freeing you up to actually go out and pursue what it is you actually want to do, like fix and flips or continuing to real estate invest, is well worth the investment. And so, generally a bookkeeper is going to produce like a P&L, a profit and loss sheet, a balance sheet. But going beyond the P&L, you can get budgeted, you can stay organized, you can have some strategy and actually know what's happening with your business so you can make informed decisions, right? You're going to ease your reporting, number one, for tax, but if you're ever going to go out and get investors, having clean books and records is like, that's not even step one. It's like the ground level. You have to have that before you can even think about going out and getting investors. And frankly, just yourself, right? You need to know what's happening with your business at any given point, and bookkeeping is going to do that for you. You're going to be able to track your profit, track your growth, increase your cash flow. You can get snapshots at any time kind of what's happening within your business. And all of that's going to allow you to focus on strategy and then partner ultimately with somebody like me or other business advisory firms to actually do analysis, to actually look at your company, recognize opportunities, and also if you have goals, ways to actually go after those goals and the timing of how you're actually going to meet those goals, right? So bookkeeping is like the ground level. It's not even step one, it's even back before that. But good bookkeeping makes all of the difference. So I'm hammering financial analysis, and let me talk a little bit about what that looks like, right? So financial analysis, really, there's a couple different ways you can approach it. We can do cash flow forecasting, and anytime I talk about forecasting, what I'm talking about is using your actual numbers as a guide for what your future is going to look like. We can leverage software that we have that actually allows us to look out 6 months, 12 months, whatever it may be, and we can do scenario modeling. And so what that means is we can run what if scenarios, right? And just basically say, well, if the market turns down however much, what does that look like and where are you? And if that happens and you do these number of investments, are you going to be stuck, right? We can actually run these types of analyses and actually figure out, a little bit of strategy and maybe what's going to happen. On the other hand, you could look at it and say, well, if things continue the way that they are and the market's great and strong, is this the time for me to take it to the next level, hire more contractors, go after more properties, whatever it may be. So really, we're looking at what if scenarios and projecting out into the future so you can make really informed and really good decisions with how you move forward with your business. I talked about planning and budgeting, right? Financial analysis is absolutely going to help you figure out exactly the different components of your financial picture and what it is that you need to do. KPIs, key performance indicators. So depending on what you're doing, be it rentals, fix and flips, whatever, what we can do is run your scenario against basically what is like a national average for people in that field, and then see, are you way out of line, right? Are you spending way too much on your contract labor? Are you spending way too much on your carry costs? Things like that. Finally, we can look on return on capital invested, which is very exciting. And I'll show a little bit of what that looks like. So these are examples of actual reports and kind of part of the financial analysis that we've actually done for some of our clients. But here, just top 10 non-payroll expenses, just a great visual way to see exactly where all your money's going, what your expenses look like. We got how much money are you making on your investment. So looking at the return on capital employed, right? If you're investing in the stock market, it's very easy to get these types of reports because they'll compile them for you, and it's kind of easy to, your brokerage basically does this for you. But in real estate, it's hard because nobody's creating these for you, right? So we can actually look at, okay, what's the return on the capital, right? How much profit are you making from your operations? Now, in these examples, September hasn't actually been entered. That's why there's the sudden drop off there. But here we're looking at net profit, right? And so we can actually look at these graphs and figure out, okay, are you growing? Are you stagnating? What? And then, kind of compare other pieces of this dashboard to figure out exactly why you're plateauing, or open up discussions about, why your business is kind of where it is and why it's performing the way that it is. Revenue growth percentage, is your current revenue growing? We can look at that. Income comparison year over year. I really liked this one when we were looking at it, just because it looked like there were some really interesting trends. But at any rate, we can actually year over year look at your income and see kind of when is your slow period, when is your fast period, what can we do to make the fast times a little bit easier on you, the slow times, what can we do during those times to, number one, maximize your time to make the rest of the year more organized, but also increase the income during those periods, and try to analyze why it is the way that it is. So these are only maybe whatever they were, 5 examples or something of different pieces of the dashboards that we can create. Really, we can create anything that you want to see. I shouldn't say such a blanket statement. I mean, maybe not anything, but really the flexibility of what we can do is pretty astounding. We can actually run a lot of different scenarios and give you really good, easy visual kind of representations of where your business is, and using the forecasting actually where your business might be further out into the future with those what if scenarios, right? So once again, good bookkeeping is going to lead itself into financial analysis, right? And the financial analysis is really key, but the other piece of this is effective tax planning. Now, this is an example of an actual tax plan that we put together for a client. It's very small there, but it's about 64 pages of explanation about all of the different strategies that you can take advantage of, and it is customized to your particular tax situation. That's why I blocked out who this actually was prepared for there. But in real life, we actually estimated we could save this client about $63,000 if they implemented some of the strategies that we were looking at. From afar, effective tax planning, you want to maximize your deductions. The general rule for maximizing deductions is that you're going to look for basically your expense has to be ordinary, necessary, and reasonable. Reasonable is often where we run into problems on audit. The best example I can give, going back to the LLCs, is the annual meeting. An annual meeting for an LLC is definitely ordinary and necessary. Everybody has an annual meeting, and it's necessary to talk about where the company is, how it's doing, what the finances look like. It's the reasonable where people run into problems. And the example that I actually use is going to Fiji, right? Flying all the way to Fiji, spending time on the beach and in tropical paradise to have your LLC meeting. Probably not reasonable, right? And I've used that example for probably, 5 years. And I actually am handling, the audit just finished 2 days ago, but the client actually went to Fiji. And the IRS examiner was not having it. So the ordinary and necessary components, pretty easy. The reasonable component is often where we see the issues. But typical real estate deductions that you might look at: mortgage interest, real estate taxes, HOA dues, travel, automobile repairs, maintenance, insurance, right? Meals and entertainment, the rules have changed there. I really should take that off. But at any rate, maximize your deductions. Repairs versus improvements, the more that you can distinguish between these, really the better, and the more that you can look to repair things rather than replacing things, the better off you're going to be. Repairs are currently deductible. If you replace a component, particularly if it's something that prolongs the life of the structure, such as a roof, then you're actually going to look at depreciating or amortizing that component rather than immediately deducting it were it a repair. So again, just try to do as many repairs as you can rather than replacing. You can create a company to manage the properties, so that goes back to the LLC structuring. And then you can actually hire your family to manage the properties, and this is a really slick trick that a lot of people take advantage of. You do actually have to pay them in cash. There are tax court cases, and one particularly comes to mind where a CPA tried to pay their 10-year-old child with pizza on a Friday night, and the tax court didn't accept that, so it does have to be in money. But if you pay your children below the amount that they actually have to file a tax return, that's shifting income from you at a higher tax rate down to your children who have the lowest tax rate. And of course, young children probably shouldn't have a lot of money. And so what a lot of people do is they just put it into an IRA or something like that, maybe a college savings account or something like that to help defray costs later. So that's a very good strategy that everybody should be taking advantage of if you have kids. You do want them to be older, right? We don't necessarily want like a 4-year-old on payroll or something, but certainly, preteens, teens, that would be fine. Anytime you're holding a property for investment, you think about your exit, right? You can defer your gain by using an installment sale. You can use a 1031. Now there's opportunity zones as well that you might be able to look at. So there are certainly exit strategies that we want to look at and leverage if we can. I'm not going to go into real estate professional too hard just because of the time constraints here. But if you can qualify as a real estate professional, that is one of the most powerful tax deductions that you can possibly take as anybody involved in real estate. What I'm going to do is give that short shrift right now, but then maybe we can return to it as I kind of stay later and answer some questions. We talked about the SCorporation, another very important tax planning tool and a way to save roughly about 15.3% tax on what would otherwise be taxed with that self-employment tax rate. Okay, this is the last kind of tax planning tip, and Justin, I'm going to ask for you on this, but do you know what the depreciation recovery period is for non-residential real property, like commercial property?
What is it, like 35, 37, 40 years?
That's good. Yeah, good guess. 39 and a half. Yep. And residential real property, 27 and a half, right? And so where we have a very large purchase price and we're going to depreciate that over such a long period of time, that's not very tax advantaged, right? And so you can take advantage of what's called a cost segregation study. And basically what that does is it chops up the purchase price into a lot of different components. So rather than everything just going into the building and the land, part of the purchase price is going to go into the carpet, part of it's going to go into the drywall, into the wiring and the walls, basically all the different components. And then those components have a shorter depreciation life. So rather than depreciating something over 39 and a half years, for instance, maybe we can actually get it recoverable over 7 years or 5 years, right? So you're kind of front loading and maximizing your depreciation right up front. So everybody with a buy and hold should really consider one of those cost segregation studies. So that is the bulk of what I wanted to talk about. Given time, Justin, do you want to pause for questions? Should I just power through the last slides here?
Yeah, if you're thinking you can do it pretty quickly, yeah, let's keep going.
I think I can do it pretty quickly.
Starting to fill up, and I'm sure once the day you're done, we'll have even more questions. So yeah, let's get through a couple more slides, and then we'll dive back into these questions.
Cool. So pricing optimization, this is what you hear about a lot at these real estate investor groups. And Justin, you, I'm sure, actually know way more about, after repair values and ways to get there than I do. But what I like to do and what I can recommend or maybe help with is any of the components that go into that ARV, right? And so just evaluating your deal in general, evaluating closing costs, holding costs, repair costs. Again, going back to that idea in a way of those KPIs, the key performance indicators, we can certainly partner with any of your existing advisors to help kind of drill down into the details of actually analyzing your deal and helping you optimize your price, right? And then team cooperation. I mean, ultimately, it's going back to that slide where it was me and pretty much everybody else on my team. Not everybody knows everything, right? And even within Business Innovation Group or Long Law Group, the law firm, we need to team up with people who are good people who are giving you good advice, and that's going to come from a lot of different sources, and that includes Justin, it includes Pine. And so, just as you're building your team, we can certainly be part of that team, but not only that, we can help vet other people who might be part of that team and help you build a really good team moving forward, kind of no matter what stage you are in your real estate investing. So hopefully team building makes sense. It's not a real difficult concept there. But you're not alone. Business Innovation Group certainly can be part of your team. And with that, let's open it up to questions.
Yeah, just in case some folks need to log off, can you go back to the slide with your contact info, just in case there's some more personalized questions. Somebody wants to dig deeper, and ask you something. That way they can find it. Perfect. All right, so going back to hiring your family to do things, and specifically you had mentioned like manage properties. So the question was, in Colorado, don't you need to be a real estate agent or have a broker's license to manage properties?
Yeah, I'm specifically speaking about your own rental properties, not other rental properties.
So you can manage your own, you can self-manage properties, which means you can hire your family to self-manage properties. But if but you can't become a property manager and have like your son or daughter manage somebody else's properties unless they
Correct.
are licensed.
Correct. And then the other nuance there would be if you are a real estate agent and you want to be a property manager, you could hire your children within your property manager business to do kind of clerical or admin tasks.
Gotcha. Perfect. All right. Here's a cost seg question. When you do cost segregation, do you have to recapture depreciation when you sell?
This is such a good question. It really is such a good question. And I've been asked it a few times, and the answer there I think is yes. If you're going to, you're not. It's kind of weird. You're not going to recapture depreciation because you did the cost segregation study. Like it itself does not like trigger depreciation recapture. But if the component that you have and you've identified as part of that cost segregation study then requires depreciation recapture, then yeah, you're gonna owe that. So it's going to be driven, I guess, by the depreciable life and the method and all of that of the asset itself that you've identified for the quicker depreciation.
Gotcha. So as you're contemplating or going through a cost seg, yeah, that's line by line be asking those questions. All right. Can you please go back to the slide that you said there is a big tax deductions for real estate professionals?
Yeah. Absolutely. And I'm actually going to shut my door. I have a guest in the office here who's making some noise, so I'll be right back. Okay, I'm back.
All right, and so I guess let's just leave that up, and if they have any follow-up questions, they can ask. But going back and still talking about the cost segregation and recapturing, what kinds of things do not require recapture?
Well, so the way that I can explain this from an extremely high level, because it's actually a pretty heady topic, depreciation in general. There's makers and there's acres. Acres is accelerated cost recovery system. Makers is modified accelerated cost recovery system. And then there's bonus depreciation. There's basically these programs that we have where you're accelerating and front loading the amount of depreciation that you're taking. And if you're going to hold the asset for the maximum amount of its life, like let's say that the asset has a 5-year recovery period, right? it doesn't matter if you take extra depreciation at the front and less depreciation at the back, so long as you've held it for the 5 years, because you're taking at the end of the 5 years the same amount of depreciation. And so if you accelerate in year 1 and year 2 and then you sell the piece of property, you've taken too much depreciation than if it were just over a straight line, right? And so the amount of the extra depreciation that you're taking, that's what the recapture is. So anything that has an acceleration to it, that you can take the acres or the makers or the bonus depreciation, that potentially can trigger recapture if you're still within the recoverable life, or the life of the asset.
Interesting. They say thank you. That makes sense.
Okay, good. It's funny because that's one of the things that they never teach you. The law school never teaches you this, the bar never teaches you this, and the firm doesn't teach you this. But it's like basically they throw you in a room with 2 other people and they say, take these really hard concepts and explain it in 30 seconds. That's
Right. So another cost seg maybe question: how fast can improvements be depreciated? Specifically, can we use Section 179 or write off all in the first year to sort of equate to repairs? Is there a limited dollar amount?
Yeah, and we're beyond the scope a little bit of what I'm here to talk about tonight. And so specifically, you may want to reach out to me with more detail about this. And let me give you my actual email address. The one that was on the slide was like info@big, that's going to go to my admin staff. So my actual email address is P McFarland. It's my first initial, my last name, P McFarland @longlg.com, like longlawgroup.com. P McFarland @longlg.com. Just shoot me a note there. But from a very high level, yes, 179 is available. Bonus depreciation is also available. There are a lot of programs, and as part of tax change, the Tax Cuts and Jobs Act, bonus depreciation, the opportunities for that actually increased greatly. But there are rules around that, and it depends on what kind of components you're going to put in. For instance, escalators have special rules, HVAC has special rules. So it kind of depends on what you're going to put in. And then the first part of that question was, like, what's the life? Well, the life is actually governed by what component it is. Like carpet has a different life than an HVAC system, which has a different life than a roof, which has a different life than countertops, right? So every single component has like a different depreciable life depending on the rules surrounding depreciation. So you'd have to go item by item and figure out what your method is.
Gotcha. Yeah. Very good. Well, I think, no, here's one more. If you want to tackle bookkeeping on your own, do you have a software that you like best for rental properties?
Yeah, I mean, again, I really can't underscore enough that you just shouldn't do your own bookkeeping. I mean, that's the starting point, because it all goes back to that idea that the bookkeeping is the language of your business, and really you have to have the clean numbers to even see what's going on with your business. Now, I understand certainly at the beginning and whatever, that it may be more cost than you really want. Certainly understand. There's very real situations where it is the best move to just do your own. If you can afford bookkeeping, it's well worth just offloading it. That said, QuickBooks really is the best. There's a learning curve associated with it, just like anything else. But really, that's what you should be looking at. QuickBooks Online is convenient, and in some ways it helps kind of do some of the analysis, but I find it to be really clunky. And depending on the size of your business, you actually run into limitations with the software where it can't run certain size batches and other things of data. So the desktop version is probably a little bit better in terms of volume and being able to handle volume. But otherwise, I'd consider QuickBooks Online.
Perfect. Well, Peter, I think that about handles all of our questions. So unless another one pops up real quick, any final thoughts?
Yeah, not particularly. Yeah, I mean, it's just going back to that idea of just the pillars kind of feeding into each other, right? For me, it's kind of like I think a lot of people go through their business kind of life or annually kind of what their business does, and they have their bookkeeping or they figure out their books, and then they go and they do their tax return, and then they congratulate themselves on a job well done, right? That's probably 95% of business owners out there. And to me, and what I'm seeing as possible through kind of the new services that we're doing, but it's not just us, really, where the industry, where the accounting industry in general is going, that's now becoming the bare minimum, right? Being able to leverage data and being able to do the forecasting and the analysis, that's really, really cool. That's where this industry is headed. That's what your competition is going to start doing. I would call on everybody to highly consider, kind of taking it to that next level.
Perfect. Appreciate that. That's it's really, I think, eye-opening, and I like the way you have it organized, because really one leads to the next, leads to the next, and then the more of these pillars that you go through, the even if you have the same business today as you did yesterday, you'll be hopefully putting or keeping more money in your pocket, and that's almost the point of it, right?
That's what I've built my whole career on, and it's also, as you say, why it's not that sexy. It's like I'm not going out and telling you, here's how you're going to make $1 million, whatever. It's more like, okay, I'm going to tell you how to keep, as much of that $1 million as you possibly can, and
Yeah.
it's coming kind of from, as you say, the back end of the office, and it's true. But I mean, taxes alone is probably one of your biggest line item expenses, right? I mean, why not look at saving money there? And the tax coaching that we do absolutely can pay for itself, right? In year over year.
Yeah, absolutely. Well, very good. So if anybody needs to dive a little deeper, if you have deeper questions to ask Peter, please, he shared his contact info. Please reach out to Peter if you're interested in working with him on any of these things. You have his contact info. And then, of course, if you need some hard money for your projects, Pine Financial is here. If you want to just talk about going deeper and need a little hand holding in your business, I'd love to chat, one-on-one, and see if maybe I can help you out in that way. But regardless, thank you for sticking around. Looks like almost everybody stuck around to the very end. Really appreciate it, Peter. Awesome presentation and great information as always. And until next month's webinar, please, if you're in Colorado, if you're in Minnesota, go check out those websites, mniss.com and denveriss.com. We'd love to see the Investor Success Summits coming up soon. So with that, thank you, everyone, and look forward to seeing you next month on the next webinar.
Yeah, thank you. And everybody go to the Success Summit. It's a ton of fun.
Thanks, Peter.
Thank you.